Welcome to this edition of the Pepper 5 podcast series. In this series, we take a look at some of the current legal trends in the marketplace and cover them in 5 questions for our audience. Today we wanted to look at the current climate for co-investment in private equity. Joining us are 2 leaders of Pepper's commercial department. Bruce Fenton is a partner and head of the firm's investment funds industry group and private equity practice. And Julie Corelli is a Pepper partner and head of the firm's fund services practice, in addition to being co-chair of the commercial department. Julie and Bruce, welcome.
Hi, Brian.
Hi.
We wanted to invite you both to this podcast because Pepper recently commissioned Mergermarket to interview 50 private equity executives from across the United States that have co-invested with an institutional investor within the previous 3 years. Now, Bruce, you were a major help on this project from Pepper's side. Why are private equity groups relying more on co-investments?
Well, there are a lot of reasons, but there are really 4 major ones. The first one is the deal market has been what people refer to as frothy. Valuations are high. Investment bankers have done a great job of making processes very competitive. So the purchase price for good companies is and has been pretty high for the last couple of years. As private equity groups look to figure out how they're going to finance these purchases, particularly with banks post-2008 crisis tightening up to a certain degree on the amount of leverage available, co-investments provide an ideal opportunity for finding that extra capital in order to make the equity, write the equity check for the purchase price. In addition, co-investments help private equity groups in finding new limited partners. They'll do a deal together. They'll like one another. They'll like the way they work together. And when it comes time for the group to raise a new fund, they're a natural place to go. Kind of the flip side of the same coin, co-investment opportunities are, quite frankly, rewards to LPs for having invested in either prior or current funds. It's a way for LPs to put more money to work. It's a way for LPs to perhaps get different terms, and I know Julie will be talking about that as well, get different terms in the co-investment vehicle than they would as an LP in the fund. So that's another reason. And then finally, there are a number of LPs that are very targeted in terms of their investment strategy and who their deal professionals are. So it's finding co-investors is a way to get additional industry expertise, not only available for helping to manage the portfolio company, but in particular to get deal expertise that is committed. No pun intended, but committed both from a capital perspective, but also from the perspective of really being interested in how the portfolio company does. I mean, you can get industry expertise by getting independent directors, and you can try to incent them through equity plans, and that does work, and that's a proven model, but the incentive is geometrically greater when the co-investor has significant dollars invested.
And Julie, you participated in a couple of Q&A pieces with Mergermarket for the final study. One of the findings of the study were that over 3/4 of respondents see regulatory scrutiny as one of the biggest challenges to co-investments. Based on your practice, what are some of the regulatory concerns that PE firms should have with co-investments?
Well, I think Bruce actually touched on one of the primary ones, which is to put it in the regulator's parlance as opposed to the fund manager's parlance, would be to say that there's favoritism going on to the limited partners. That sort of bring the relationship closer. Yes, it's to bring strategic investors closer to a portfolio company, but it's also to build a relationship between a fund manager and offering a deal to a limited partner to co-invest in order to curry favor to invest in the next fund would be something a regulator would be extraordinarily concerned about. So regulatory concerns do play a big part of it, not only because of that favoritism piece, but also the way co-investments come about. The way a fund grows, the way it goes through a fundraising process and then deploys its capital and then harvests its capital. The co-investment arrangements, if they were done the way the regulator would like them to be done, they'd have to be done in the fundraising phase. Well, that's not when you need the money. You need it during the deployment phase. And certainly they overlap a little bit, but the disclosures that the regulators are looking for have to be built in that fundraising phase long before you know what you're going to need for the particular portfolio that you're developing. The allocation of the opportunity to different limited partners, therefore, is something that fund documents tend to be pretty bland about. They're pretty generic. They leave a lot of open room, and when there's open room and you act under it later on, the regulator with 20/20 hindsight has the ability to second guess whether you did the right thing. There's often a proclivity to presume you didn't do the right thing, so there's tension there. So what do you do to resolve that? You have guidelines which decide in advance, or help you, guidelines you set in advance so that you can decide later how you're going to determine whether the size of investment is suitable for your fund, and when it's larger than what's suitable for your fund, where you're going to offer those co-investments. And you might decide up front, right in your fund documents, that you're going to offer them pro rata to all limited partners. That's going to be pretty much of an administrative nightmare later on. Or you might decide that you're not going to say pro rata, and it's going to be to the largest ones first, and after that could be the principals, it could be anybody else. But that disclosure is key up front from a regulator's standpoint. The other thing the regulators look for a lot is the allocation of expenses between the co-investment vehicle and the fund, and there's been several SEC enforcement actions dealing with this recently in particular. That allocation has to be fair and equitable, and it has to have been disclosed in advance on how you're going to do it. And if you don't, there's just a risk that a regulator with that 20/20 hindsight is going to pull the pieces apart and find something to complain about.
Bruce, in your view, what are the benefits of co-investments?
Well, a lot of them come out of actually both the answer to your first question to me and the things that Julie was talking about. Obviously, from the PEG's perspective, the biggest advantage or benefit to co-investments is, on the one hand, the ability to get the extra capital needed to fund deals in the current deal market. And the flip side of that is, even if a private equity group has sufficient capital, it's a way to hedge risk. Private equity groups may not want to deploy the amount of equity needed, the amount of capital needed in order to stroke the full equity check. Co-investments give them the ability to spread that risk over the other co-investors without, if done properly, without losing control of the investment. There are contractual provisions as well as structuring techniques that can be used to enable a sponsor to actually put in a minority, an absolute minority of the equity capital, but still control the investment as if they had put in a majority of it. So hedging risk and getting the deal done are obviously the biggest ones. We've already talked about both the help in finding LPs and the reward for rewarding LPs for investing, and of course there are the risks that Julie talked about with that. Also, co-investments allow private equity groups to establish relationships with other private equity groups. A pre-co-investment environment, PEGs kind of looked at one another in one sense, as competitors for particular deals. Now, with co-investments becoming more and more popular, they can collaborate and cooperate. So, although they certainly do compete in the initial stages to try to get exclusivity and to control the investment process, there is much more opportunity for PEGs to collaborate down the road. And then finally, as mentioned earlier, co-investors bring particular industry expertise, and they also frequently will bring with them operating partners, particular professionals who have not only general expertise in a particular area, but have relationships with these investors in which they're more specifically parachuted into the portfolio company in order to go beyond management at the board level, but actually help develop strategies and implement those strategies to bring the portfolio company's business plan to fruition.
I just would take the LP's perspective and add a few points about why limited partners like co-investments so much. Agree with everything that Bruce said about the private equity group. From the LP's perspective, the co-investment offers a huge opportunity for expense reduction, and that's often what they're looking for, to juice the returns through lightening the expense burden. The regular 2 and 20 deal, as we all know, management fees get a lot of pressure. The 20% carry has held on through decades now, it seems like, and there's a little bit of movement up and down above that and tiering of carry and all that. But co-investment vehicles are often management fee free and carry free. And so for the limited partners perspective, the more money that they can put into that bucket as opposed to the fund bucket, the better off they are from the expense burden standpoint. For the same reason, the manager doesn't want that much to go into the co-investment bucket as it wants in the fund bucket. But there's that negotiation that occurs, and as a result, at the very least, co-investments have reduced fee and carry burden, and they're often free of management fee and carry. And that is also something that needs to be looked at as you're doing the fundraising and raising the co-investment money. Is it something that is worth it to the manager to go through the administration of the co-investment vehicle if it is indeed going to be fee-free or carry-free? So all of those factors play into the balance of how much money goes into co-investment and how much into the fund.
And Bruce, based on the study results, what were the deal terms most often included in co-investment transactions, and in your opinion, why?
Well, the perfect question to follow on what Julie just said, because the negotiation between the LP and the sponsor in terms of the economics that Julie was just talking about, in terms of expense sharing and reduced carry or carry-free transactions, come up all the time. As Julie said, there's a particular position that it's a sponsor-favorable position would not be to do those things, and an investor-favorable position would be to do those things. So that's more of a zero-sum game. So there's resistance by the sponsors to doing that in many cases. So in terms of what the deal terms most included, you typically see things like drag-along rights and the corresponding tag-along rights included. You would see provisions relating to giving kind of almost preemptive rights in the next deal on a proportionate basis, so that if the co-investor commits to be in the investment, that the co-investor is not going to be diluted in future investments if the co-investor wants to keep investing. And Then you have more regulatory driven, to be sure, but more kind of procedural, administrative points like a separate audit of the co-investment vehicle being required by the co-investor. Those are the ones that are most frequent, and then you have the economic ones that Julie talked about that you see a lot, but less frequent because there's, as I said earlier, a real zero-sum game aspect to it.
Our fifth and last question will be for Julie. Now, Julie, we are seeing this topic of co-investments everywhere. You are also speaking at the PEI CFO COO Forum in New York City on January 27th, 2016, on this topic of co-investing. One of the parts of your panel is handling the administration of LP co-investment. What are some of the best practices here?
Yes, there's a broad array of practices when it comes to co-investments. The manager and their experience with it, and the co-investor and their experience with it, are key components to how well the administration goes. Many people start with an allocation committee, so they allocate the opportunity, they look at how the opportunity is being allocated for the investment to co-investors and to the fund, and that's where the documentation will really start. The documentation of that decision about suitability and who's going to be offered co-investment rights, and the timing of how much they're being offered, and the timing of what they're going to be offering. The other thing in terms of documentation is to think about how to routinize the package. It sounds sort of mundane, but there has to be a time during the co-investment transaction when the co-investor gets all the disclosure material and all the information that the private equity group has developed over the course of investigating and diligencing and documenting this deal. That package should be communicated early and often. The package isn't, but the information that's in it should communicate early and often to educate the LP, so that when they get the comprehensive package about the deal, they're in a position to move very quickly, because by that time, when things have solidified well enough, all the deal people will tell you they need to close in the next day or two. So there isn't a whole lot of time for the co-investor to make that decision and sign on the dotted line. So they have to be ready to go. That is a practice that varies all over the lot. Some people will have a what I would call a routinized package, which is the original LOI, the final documents, the diligence report, any non-reliance letter that has to be signed. It'll all be right in the same package, and every co-investor would know what they have to sign, and they can get it done relatively fast. Where things trickle in over time, it's a little bit harder for the co-investor to handle. How difficult it is to make a decision can be directly attributable to how the deal is structured. Is the co-investment a direct investment, in which case you're looking at the operating company documents or a holdco set of documents, or is it an SPV that's been set up, which is a standardized agreement that's used over and over again? And the standardized agreement, probably providing for no fee, no carry, would be something that's easier to get done faster. But then there are many, many, many co-investors who say, oh, well, wait a minute, we have this great side letter for the fund. We want a side letter for a co-investment vehicle. And the process starts to get bogged down that way. So figuring out whether you have co-investors who are going to need those side letters, because sometimes you end up with as many for the co-investment vehicle as you have for the fund. The special reporting, the blocker need, there could be any number of things that go into the side letter. So that understanding how they're going to come out on that approach is good. The other thing that challenges administration of co-investments, I would say, would be how to deal with future capital needs. So the portfolio company needs something, a follow-on investment, down round to protect it, or just growth capital. And you have to figure out a way for that co-investment vehicle to participate in that. So is there a capital commitment made to the co-investment, or is it a capital call basis, or do you leave that co-investment vehicle standing alone and have the fund, which has dry powder, able to take up that next round that the portfolio company needs. Those things need to be thought about, disclosed, and dealt with in advance, and the best place to do it is in that disclosure package that goes out to the co-investor.
Julie and Bruce, thank you both for joining us today. Now, we only covered a portion of this topic, so for our listeners, please visit www.pepperlaw.com/podcasts/co-investments, where this podcast is posted, to download a copy of the full Merger Market report. I hope our listeners find this interesting.